Your mortgage rate is not set in Washington. Not anymore. This week, the 30-year Treasury yield touched 5.3%, the highest since 2007. The Fed is on hold. The White House wants cheaper money. The bond market looked at both of them and raised the price of everything anyway. Your mortgage, your car loan, the interest bill on nearly $40 trillion of national debt. So who actually sets the price of money in America? The last time the bond market turned on Washington, a president summoned the entire Federal Reserve into his office and lost. This already happened. February 1951. The government is fighting a war in Korea, prices at home are climbing at the fastest pace since the last one, and the President of the United States is about to make the Federal Reserve an offer it cannot refuse, except it did. And the man who refused the loudest had already been fired once. Start with the deal. In 1942, with the country at war, the Federal Reserve agreed to something extraordinary. It froze the price of government money. Treasury bills pegged at 0.3%, long bonds capped at 2.5%. Whatever Washington needed to borrow, the Fed would print the demand to hold rates there. Wartime patriotism, institutionalized. For the ordinary saver, the pitch was simple. Buy bonds, back the war, 2.5%, guaranteed. Then the war ended and the fine print arrived. Price controls came off and inflation did what inflation does. A saver who bought that guaranteed bond at the end of the war watched roughly a fifth of its purchasing power evaporate by 1951. The coupon was guaranteed. What the coupon could buy was not. The peg survived the biggest war in history. It could not survive a smaller one. In June 1950, North Korea invaded the South. Washington started spending again, and Americans, remembering wartime shortages, bought everything that was not bolted down. Inflation blew past 8% a year. By the Richmond Fed's later account, prices in the winter after the invasion were running at an annualized pace above 20. Inside the Fed, the math had become unbearable. Holding the peg meant printing money to buy every bond the market did not want. Printing money meant feeding the inflation. The Fed wanted out. President Truman wanted the peg. And in fairness to Truman, he was not defending an abstraction. As a young man, he had watched the Liberty bonds of the First World War sink in price, burning the veterans who held them. By most accounts, he sincerely believed that defending bond prices meant defending the little guy. Good intentions wired directly into a money-printing machine. On January 31, 1951, Truman did something no president had done before or has done since. He summoned the entire Federal Open Market Committee to the White House, not the chairman, all of them. The committee filed in, listened to the president talk about patriotism and the war effort, and filed out, having promised nothing. The next morning, the White House announced their surrender anyway. The Fed, it declared, had pledged its support to President Truman to maintain the stability of government securities as long as the emergency lasts. There was one problem. No such pledge existed. Enter Marriner Eccles, Utah banker, Franklin Roosevelt's Fed chairman for 14 years. Truman had demoted him 3 years earlier, and Eccles, out of principle or spite or both, had refused to leave the building, staying on as an ordinary governor. Now he decided the public record mattered more than whatever remained of his career. Without asking the chairman, without asking the committee, he handed the Fed's own confidential memorandum of that White House meeting to the New York Times and the Washington Post. The Times headline, "Truman is disputed by Reserve Board. A sitting president publicly contradicted by his own central bank in the middle of a war." 3 weeks of furious negotiation later, on March 4, 1951, the Treasury and the Fed issued a joint statement, a few paragraphs of gray bureaucratic prose now known simply as the Accord. The peg was dead. For the first time since Pearl Harbor, the price of American money would be set by markets and monetary policy, not by the Treasury's borrowing bill. Now look at this week again, because the shape should feel familiar. A government running a deficit north of $2 trillion a year. Inflation stuck above the Fed's target, fed by tariffs and energy prices. A labor market that just shed 23,000 jobs in a month. A new Fed chair, 3 months in the seat, holding rates while the pressure to cut builds by the day. That is the 2026 version of the 1951 squeeze. The government needs money to stay cheap at the exact moment inflation says it cannot be. And the bond market is voting, not just in New York. Japan's 10-year yield is the highest since the mid-90s. France, Germany, South Korea. Long-term borrowing costs at records or multi-decade highs. Everywhere at once, the holders of government promises are marking those promises down. Here is the machine under the hood. The Fed controls one number, the overnight rate, the price of money for a single day. A 30-year mortgage does not live there. It is priced off the long bond, and the long bond is priced off three things: what inflation will average over decades, how much new debt is coming to market, and something traders call the term premium. The extra yield an investor demands for babysitting Washington's promises for 30 years. Look at that list again. The Fed only steers the first item, the other two belong to the market. That is what the bond market turned on Washington actually means. Nobody rang a bell. Millions of bondholders just quietly raised the price of trust. James Carville, the political strategist, said it plainly back in 1993. If reincarnation was real, he wanted to come back as the bond market because you can intimidate everybody. Presidents come and go every 4 or 8 years. The market that prices their promises does not, which brings the story to a seduction making the rounds on social feeds right now. Hand over $1 million, collect $53,000 a year, guaranteed for 30 years. Retire on the long bond. The pitch is the loudest it has been in a generation. The saver of 1945 heard the same pitch at 2.5%, guaranteed, patriotic, safe, and inflation quietly repossessed a fifth of it. A fixed coupon is not safety. It is a 30-year bet on the future behavior of prices. Sometimes that bet pays handsomely. The one thing it never is guaranteed in the sense that matters. But here is the twist, and it is the part 1951 most wants you to see. Washington never actually beat the bond market. It settled with it, and the settlement came with a strange clause. The Treasury sent its own man, William McChesney Martin, the assistant secretary who negotiated the accord, across town to run the Fed. The Fox dispatched to guard the henhouse. Martin ran the Fed for 19 years, from 1951 to 1970, and became the most stubbornly independent chairman in its history. The man who described the Fed's job as ordering the punch bowl removed just as the party gets going, a line, he was careful to admit, he had borrowed from an unnamed writer. The story goes that Truman, passing his former negotiator on a New York street years later, said exactly one word to him: traitor, and kept walking. That is what Fed independence actually is. Not a principle handed down from the founders, a peace treaty dated 1951 between a government that wanted cheap money and a market that refused to supply it. Which means the pressure campaign of 2026 is not an attack on some neutral referee. It is a renegotiation of that treaty, and the long end of the bond market, the 5.3%, is what the other side's opening bid looks like. Now, where the rhyme breaks, because it does. In 1951, there was a formal peg, a standing wartime promise to buy bonds at a fixed price, and the fight was about ending it. There is no peg today, and nobody at the Fed has surrendered anything. July's decision to hold rates happened despite the pressure, not because of it. The direction is different, too. Truman demanded artificially cheap long-term money for a war. Today's pressure is for short-term cuts in a slowing economy, a defensible argument, not just politics, and part of this year's rise in long yields is plain arithmetic. More bonds to sell, buyers demanding more term premium. That is supply and demand, not rebellion. If yields drift back down this fall, it will not mean the market surrendered. The market never declared war, it just reprices. So what is worth watching next? 4 dials. First, the long bond auctions. The Treasury is already paying more to borrow for 30 years than at any point in a quarter century. If buyers keep demanding more, that pressure eventually lands on every rate you pay. Second, the gap between the 10-year Treasury and the average mortgage rate, about 2 full percentage points right now, fatter than its long-run norm. That spread is the market's distrust surcharge, and it moves before the headlines do. Third, Jackson Hole, the Fed's late August summit in the Tetons. The official theme this year is payments technology. Listen instead for one word, coordination, anywhere near the words Treasury and Fed. Because the real lesson of 1951 is not that the central bank won, it is that when a government needs cheap money badly enough, it does not defeat the bond market. It sits down with it. Fourth, the September Fed meeting, not the decision, the dissents. Committees crack in public minutes before institutions crack, in fact. None of this says where rates go next month. It says what kind of fight is on the screen and who has held the high ground for 75 years. Your mortgage rate is not set in Washington. It is set by the holders of nearly $40 trillion in American promises, voting every trading day on whether those promises still hold. In 1951, their disbelief redrew who runs the dollar, and the arrangement they extracted is the one being stress-tested right now. So watch the 30-year. If it keeps climbing while everyone in Washington demands cheaper money, you are not watching a policy debate. You are watching the treaty come up for renewal.